Today I will just be going over some market updates and events that happened recently. These are the topics we'll be going over today. Again, none of these are investment advice. These are just my opinions. Please do your own research. So less than a month. Obviously, the US election is a big thing. Um, So let's get to it. For the Biden scenario, he's leading in polls and potentially getting the Senate control as well. And so we could see the three branches of government completely control under the Democrat. Historically, that has been a big spending term. And he also promised that there would be higher corporate taxes and obviously a lot more stimulus. I don't think the probability of him being able to raise taxes on the masses, and so a lot of the spending will be um, financed by the central bank. That means more money printing. So this is again bad for the dollar, but something the stock market is not discounting. Yes, they're thinking, okay, if Biden wins, then we'll get more stimulus, so that's good for the stock market. But the problem is at the same time, it's actually bad in the long run. Short term, it's great for liquidity, but long term, it's harming for the actual economy as, there's a debt problem. There's too much debt in the US, and more debt is not going to be the solution. And they haven't even started to factor in the higher corporate tax rates, where Biden has mentioned that not only is he going to get rid of the Trump tax cut, he's also going to raise taxes more. So not only does the market have to price out the Trump tax cut, which is the rally we've seen from 2016, but also starting to price in a even higher corporate tax rate. And obviously, you still have the idea is that he's trying to impose a higher capital gains tax. So you could see a lot of investors, high net worth investors, trying to get out by December instead of normally they're locking in tax losses. They are actually trying to get their gains out this year. Anticipate, especially if he wins. So we could see a big drop um, um, in November and December. We'll see how it goes. The Trump scenario, his only really hope is maybe if the economy, or at least the economy is already bad, like the stock market is just being fueled um, with liquidity, and it's Main Street, it's Wall Street's gain on Main Street pain. And another thing so maybe if the stock market continues to stay like stagnant, maybe he still has some hope of fooling everyone else that the economy is great, or at least when he had it, try to blame everything on COVID. His only hope is social safety and unrest. Maybe US citizens would be really scared of all the riots and stuff. Maybe they think Trump, like they can't let Biden go on, and that will be something that accompany Biden presidency. But either way, Trump will still provide more stimulus, so it doesn't really matter. It's just, I think, uh, the more the Democrats control, the more stimulus there will be. So summary, both more stimulus, just really how much, and that's bad for the dollar long term. So Bank of China recently bought up a lot of long-term Japan government bonds, the GGBs, and so some might wonder, hey, aren't those like negative yield right now? Why are they buying it? So in summary, in an expectation for 2 to 3 years, and like a prior proof is in 2016 when they did the same thing, where Bank of China is trying to seek for higher return or lower costs of holding foreign reserves. And and something to mention is they are the second largest U.S. Dollar holder, and so that's why this could be a big thing. Bank of China is right now long the Japan yen and shorting the dollar. The details of it is it's very complicated, but in summary is that they exchange the U.S. dollar to yen at the LIBOR rate by and then they buy the short-term JGBs. The return is higher by doing that whole maneuver than holding just U.S. Treasury as yields are so low. And they could also potentially hedge with a cross-rate currency swap as well. But in general, their outlook is they are long the yen and short the dollar. So again, as one of the biggest holders of U.S. dollar, that has severe implications. Let's talk about inflation expectation. In this video, inflation will be using the definition as increase in CPI. Always, I know there's a definition of increase in money supply, which eventually go using the multiplier effect that gets into increase of prices. We'll just focus on the end part here. And if we can see from the most recent CPI report in the US, we can see, rent prices has gone down, but real estate, buying a home cost has gone down, but buying a home price has gone up, while renting has gone down. A best example would be the secondhand used car market, where a lot of factory closures, so there's not as many new cars, so people are buying up the second-hand cars. So as you can see, the economy as a whole, the necessities are actually getting more expensive, while the non-essentials have actually gone lower in price. So you'll see more of that going forward. I'm expecting, in terms of inflation, I'm expecting agriculture goods to be the leader this time around, and then the rest of the commodities. But I think inflation will be starting from agriculture. So definitely don't have to buy them at all. Just kind of follow and watch as you go. And in terms of inflation, there was extreme lows in Q2 this year and a slight rebound in Q3. That's due to mainly the immediate closures. And the idea is that if because Q2 this year was so low, if Q2 of next year stay close to where we're at right now, like Q3, or even where Q4 or Q1 is going to be, we should be seeing expected inflation going forward to move above 2%. And so my expectation is that we'll be seeing inflation really kick in either mid-February, if not late March. And you should see that in the commodities prices, as they tend to lead inflation. So not saying now is the best time to buy gold and silver or other inflation hedge materials, but definitely keep an eye out. So agriculture. So soybeans, so in the technical sense, the first wave has been satisfied. It's getting close to the November COMEX delivery, and there's a lot of volatility. I think it's going to consolidate before moving higher. Long term, however, I'm still very bullish, as Brazil and Argentina, realizing after they sold most of their stock, then the price moved up. They're like, oh, shoot, we gotta get in on this. So they started selling future contracts for next March, and they've sold, I think, 70 or even 80% of next year's production, or expected production. But planting has actually been delayed due to lack of rain. And so we could see another big rally in March next year, as that's the next delivery date on the COMEX. And for corn, it has been lacking in terms of performance with soybean. So I'm thinking it has a little bit more upside, and really need a breakout from the $400 levels. Long term, again, still very bullish. Same fundamentals as soybean. Wheat, I'm expecting it to get into consolidation soon. It's a bit more different as the production countries is not the same as soybean and corn, but long-term wise, I'm still bullish because China, as the biggest producer, with a lot of the wheat being on the northern side, has been hit hard with the, like, well, not recent, but like in a few months ago with all the tropical storms and typhoons. So all in all, agriculture is still bullish. And I'm expecting agriculture to be the starting point of where we see inflation kick in, and that should start to bring up all of the commodity prices, or in general, obviously you have some that could still be lacking. Speaking of inflation, obviously we have to mention precious metals. Gold is still consolidating. We're really waiting for an indication of inflation. A lot of people, like traders, thought they priced in everything already, but the thing is they really haven't, as there's massive amount of money printing. If you actually just compare now and 2008, the Fed's balance sheet is almost doubled from a high of 4.8 to now we're like above 7 trillion again. There's so much more money printing, much higher budget deficit and national debt. So gold should be a lot higher if you take 2008 to 2011 as your base. But obviously traders are not buying it, so we're really waiting for the inflation indication. But honestly, long term doesn't matter. It's going up. We could see a retest of the 1800 level before moving back up. Fundamentals, again, it's just the same. Just reading up the week longs. No one is pricing in the future stimulus that is coming, like regardless of Biden or Trump presidency. And the December COMEX contract is still, in terms of open interest, is still looking huge, as every day we see more and more being added in. So December could be a big month. We'll see how it goes, but either way, like I said, mentioned in previous slides, I'm expecting by like March of next year. So I'm not concerned about if you hold any. Silver already hit my target of $22 in US dollar. I already bought some silver mining stocks, and we'll trade along gold, but it will definitely be more volatile. Something to note about the stocks, a Rick Rue video recently mentioned that the junior space normally in other bull markets lags the seniors, but this year, this time around, he's saying a lot of speculators are getting too excited and moved into the juniors early. And his advice is actually buy some seniors going forward, as you're reducing your risk but still maintaining the exposure to that sector. Now let's talk about energy. For natural gas, we're really looking for an outbreak of $3, and then if we see that, then we could see a push for $4. Oil, I'm looking for a breakdown to 36 to 38, because I think a lot of the oil traders was expecting like the best case scenario, like vaccine's going to be out, and everyone's going to get back to where they are, and I don't think that would be the case. There could be some hiccups along the way, and with the different pharma companies halting their vaccine trials, I think that's gonna starting to have an impact. But if it does hit that level, I would be looking to buy one of the biggest and the best in terms of oil companies, and I'll be holding for the long term because I I still expect there to be volatility, but I as long as I'm buying ones that will survive out this period, I'm not concerned about um, having a decent profit for the long run. Uranium, we're still waiting for Japanese restart, and the problem is the low natural gas prices is not helping, as Japan is using that as for substitute in terms of energy. So in summary, like there's 7.8 billion people around the world, 1 billion still without direct access to electricity, and the idea is that the idea of all of a sudden we're just going to shift to solar, wind, and hydro is just ridiculous, especially when producing those like building a big wind turbine. Those big metal blades require a lot of energy, and that's probably coming from oil or coal. And solar panels, same thing. Obviously uses less materials, but a solar panel, like the good ones last like 10 years, but I think the bad ones, like the fast track coming out of China, I think those only last about 5 years, and we still don't have like a good recycling material or process for the used solar panels. And obviously the wind and solar are not as consistent, really reliable. Like you could see there's a lot of blackouts, and obviously cost goes a lot higher. But the idea is that people are like, we will need all sorts of energy, like natural gas, oil, uranium, and green, like quote green energy going forward. So them having being below the cost production price is unsustainable. So for base metals, I'm expecting a bull market after the precious metals, with commodities like copper, nickel, and zinc. With my expectation of weakened U.S. economy going forward, the global demand and resources will now shift to other countries, and especially in the developing countries, as when you're in developing countries, they want to live like the developed countries, and one of the biggest things they lack on is infrastructures and goods. So building grid lines, like electricity grid lines, going from a bicycle to a bike, maybe a motorbike to a car. Like all these uses a lot more commodity goods instead of services, and so that's definitely where I think we're moving towards in the long run. So in summary, in my opinion, US election, it doesn't really matter who wins. There's going to be more stimulus, and the market is not pricing in even the potential of higher corporate tax rate and higher capital gains tax from what Biden is promising. So I would not be in the US equities market, or I will also try to get out of US dollar as well. Same thing I've been saying. Bank of China is betting that for a long, like it's not going to happen like on a day-to-day basis. It takes a long time, as we see in like in 2016, where it's going to be like a 2 to 3 year process. But Bank of China is betting long on the Japanese yen and short the US dollar. Agriculture, I think, is going to be the leader of inflation, and we should be seeing that quite soon. Precious metals will perform once we find that indication of inflation. Energy, we're really just waiting for economy restart, where demand will um, spike up much higher than supply can catch up. That's when you're going to see again that supply shock and pushing prices higher. And then finally going long, like much longer term, base metals, due to the shift of global demand and resources. So I'm thinking for the next 2 to 3 years, agriculture and precious metals is where I would want to spend my time in. And then for the afterwards 3 to 4 years, that's where energy and base metals, that's where I'm thinking. And so two commodity bull market, two commodities bull market. So I'm really excited for both. Best of luck in your individual finance and investment as well.